We are on the third wave of wealth creation and the last one in self-storage. I missed the first wave of wealth creation, but in the early 2000s, me and my partners got in on what would be the second wave. Now is the third. The industry is consolidating, and this next wave is going to be massive. It's dominated by the new business model. And today, I'm gonna walk you guys through the new business model so that you can make sure that you don't miss this third wave of wealth creation in self-storage as this incredible industry continues its consolidation phase to rival asset classes like commercial, multifamily, and others. Welcome to Self-Storage Income, everybody, and I am excited to ride the next wave with you. The business model to be successful in self-storage has changed, and it's never going back again. So, what has changed, and what's this model that you can adopt easily to outperform other commercial real estate assets or other investing strategies? Well, it's a combination of a lot of different things. We're gonna break each one down in a way that you can understand and apply. But first, we have to understand the old way of doing self-storage because that has dominated this industry up until just the last decade. The vast majority of the industry just 15 years ago were mom and pop single operators. I'm talking about like 90%. Now, today that number has shrunk, but it's still 50% of all owners are single owners, mom and pops. This is a massive segment of this industry. Most industries consolidate, particularly commercial real estate, and when they consolidate, they don't ever go back. Self-storage is in that consolidation phase, and that's where the money is made. The vast majority of owners operating on the old model. Self-storage was very slow to change, especially in comparison to other asset classes. There's a reason why. And the reason why is due to its success. You see, self-storage, simply public storage, the model was cheap ground, build, and then rent, lease up and walk away. There wasn't a lot of thought going into it. You wanted to be in population, high road visibility, and people saw you and they just came in. Self-storage being the newest commercial real estate asset class out there, there wasn't a lot of competition because it was new, and demand was growing because Americans were getting more and more used to this asset class, and so they were adopting it as part of their daily lives. This was happening through the 80s, 90s, and then really picked up after 2000. But 2008 hit. 2008 rocked the real estate world, but self-storage outperformed them all. The asset class had relatively low debt in comparison. We're talking about 50% debt to equity or less. Many of them paid completely off. Banks didn't want to invest. They weren't high leveraged, and they had high margins. Hence the reason why it is the lowest defaulting of any commercial real estate asset class. But this also made them just cash cows. There was no driver for change. There wasn't really competition. Their basis was low. They didn't have a lot of debt. And every year, demand got more and more and more. Occupancies rose, rents went up, and the operators just made more money doing the same thing that they had been doing for 20 years. But that changed, and that changed fast, especially after 2018. But prior to that, operators began to utilize things like marketing and putting in websites. I know that seems like really archaic, but it's true. A lot of storage facilities after 2008 still didn't even have websites. We had a whole business model of acquiring, marketing, running them, making sure people paid their rents, and simply managing it like a business. And that created enormous amounts of profit. You see, we got into the industry in 2004, and my entire thesis was this is a business, not a real estate asset. In fact, I wrote 2 books on this that are the best-selling books in the industry. The idea was focus on the basics, acquiring customers, making sure people can find you, making sure people pay their bills, like automatic payments, and then answering your phone. Most storage facilities had a manager, and if you showed up and the manager wasn't there, You couldn't rent. That simple. And those office hours were, well, who knows? Because they didn't really follow them. Weekends off. It was literally hard for lots of customers to even rent a storage facility because they weren't open. They couldn't find them. So our business model was simple. We would improve it. Now, turning it into a business worked amazing. And it worked really well through the 2000s. But after 2018, things started to change even more dramatically. Why? Because people piled into the industry, like private equity firms, funds. In fact, over 80% of all private equity and funds in the self-storage industry came after 2018, meaning the vast majority have never even seen a real recession. But they came in to change things. Money was cheap and people developed like crazy. In fact, people said, it is recession-proof. This asset can't fail. Makes my blood curdle just hearing that. I had a huge problem with that and still do, because that is just not true. But all the new technology and all the new people coming in were driving all this change. And the change became the standard. We know we were at the forefront and leading this change with software, keyless technology, revenue management, and all sorts of different things. But this also provided an incredible opportunity. You see, if you're an individual going into an industry and you want to update and move up that asset class from a C to an A, it's just not about improving how it looks. It's about operations. But there weren't a lot of third parties and available technology to actually operate better. After 2008, that changed. People came in to offer services, technology, and lots of other things to operate, run, find tenants, and maximize those asset classes. This provided more services to, well, you and me. And today, we still have half of the industry that is operating off the old model, while we have the availability to operate the new one and have the resources to do it. So let's break this down so you can know the new way or the new model of self-storage. Why this is important. Let's say you want to develop a storage facility. In many markets, the new way isn't just better, it's actually the bare minimum. So when you're in first-tier markets or fast-growing second-tier markets, if you don't do these things, you can't compete. Third-tier and fourth-tier markets, which are heavily mom and pop and heavily old model, when you do these things, you outperform tremendously. So if you're in a place like New York or Southern California or Vegas, these things are necessary to survive. But for 80% of the geographic markets in the United States, these things are a massive advantage. First, mom and pop single operators versus private equity roll-up funds. That's me and others. When we got into the industry, we were buying them, upgrading them, refinancing, take our money out tax-free, buying another one, and building a portfolio, a brand. We got scale. And having a brand and having experience and technology, we got to improve performance. These things changed that business model and started to standardize this in the industry. The next big change was manual rent tracking, meaning that how do you decide what a 10 by 10 is worth? How much should you price it? Well, that was just looking around and saying, I have two 10 by 10s left. Bob's charging $100, so I guess I'll charge $100 for my 10 by 10s. And then you just say all your 10 by 10s are $100. That was the old way. The new way is dynamic pricing and rent optimization, which takes in the actual market rents from all the competitors, like, or what I call true competitors, mean they're actually like your asset. They're comparative in quality, location, and management. It takes in those things. It looks at your inventory, your turnover, and it changes those prices as market conditions change. So a 10 by 10 will change prices based upon market conditions, and it will move around all the time. This helps you optimize both occupancy and that what we call street rate. The next was paperless, going digital. Digital in all forms. We're talking digital lease. We're talking digital payments as far as automatic payments, not check and cash. This allowed us to do something that was even more important when it came to paperless, and that was marketing. You see, if you're paperless and you don't have to interact one-on-one with that customer, then you can change the customer experience to all online, from the point somebody Googles, "I need storage," to when they move out. They should find you, be able to rent, move in, get their gate code, their information, get their lock access, and everything in between without a manager. Now, you can see how that optimization helps you run facilities, especially small facilities that don't have revenue, to hire people, therefore improving your overall net operating income. The profit or net operating income is how we determine value. So little changes in that have massive changes in value. Adding $25,000 that you're saving in labor to a $50,000 net profit, you are increasing the value of that asset by 50%, literally adding millions. Now, once we have customers in a digital realm, this ties back into revenue management. But our revenue management system has two sides. We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others, because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it gonna look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank, it's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. The first side is just occupancy and street rates. The revenue management system on the back with the total revenue does pricing. Now, this becomes non-static pricing. That's the big change. Non-static pricing means your rental rate increases are subject to changes in the marketplace and occupancy, just like your street rate prices are. So once a person moves in, they receive rate increases in general every 6 to 12 months. This is how you optimize. As demand changes per unit and by your facility and in the marketplace, you need to open up more units for demand. You don't want to have everyone that has the 10 by 10s at $50 when your street price is $100. If you have 100 units at 50, yet you can get 100, you need people to move out. This is non-static pricing or revenue management. It plays in with that front end, finding your customer, pricing them, getting them in and signing contracts, and then managing them and the pricing on the back end. These two things are powerful when changing your overall revenue and optimizing your facility, both in terms of occupancy and pricing. When I first said occupancy doesn't matter, after 2008, a lot of people in the industry looked at me like I was crazy. The reason being is I came from a business background, cash-based businesses. And it was simple to me. If I had 10 units and every one of those units I rented for $100, that's $1,000 a month at 100% occupied. So 100% occupied, 10 units, $100, $1,000. Easy. But what if I lost 70% of all my tenants? Devastating. Unless I'm charging $1,000 a unit. Now, I only have 30% occupancy, but I have $3,000 a month. I would much rather have $3,000 a month and 70% vacancy than 100% occupancy at $1,000 a month. That is the balance that these systems do. It may sound complicated, but in fact, we have a tool that we utilize and I created so people can do this, and they can actually see how much money's on the table, as I call it, meaning how much money you should be making versus how much you are, and that extra profit you can make. So find the link below and you can check that out. The system that I created, I call now Metrics. was literally off how we found that money on the table. And now you can see that too. The next big change was branding. People used to think branding didn't matter. All they did was call it AAA storage. You've probably seen that a lot. AA storage, or some other weird name that doesn't seem to make sense. The reason they did this was they were trying to be the first in the yellow pages. That's right. Even after 2015, we were buying storage facilities and we were changing the name from AAA storage and stop paying yellow pages to a modern recognizable name. And the brand recognition isn't for outside. It's actually not nearly as much for your customers as it is for Google. Why? Storage is on demand, meaning that if someone needs storage and they call your facility and you don't answer the phone, they're gonna just call somebody else and rent from them. They don't rent from you because you're a Marriott, but they rent from you because you exist. In most markets, when people go to rent online, which is the vast majority of all rentals, I'm talking over 85%, that marketplace, only a handful of facilities will even show up. That means if you're not showing up, you don't exist. Now, this is true for every business today. But you have to remember, you have an entire industry that was built on simply drive-by traffic. They put no work into even being able to be searched on Google. With brand scalability, it also created centralized websites. This meant I could grow by unit, not actual storage unit, but by facility, add them, and my domain authority rises. My marketing in the marketplace through ads and everything else gets better, and I can drive down costs. My acquisitions go up and the price per acquisition goes down, making me much more profitable. So brand recognition is really a marketing game, but not because brand recognition is important to customers, but instead it's important to data aggregators and online traffic for search engines. This is the new business model. It's how you perform, it's how you operate. But this is an industry where there are markets all over the United States that none of the competition is even doing this, meaning you can step in and dominate the industry. Self-storage income, that's what we teach. We teach that in the podcast, in the books, and also our community, showing how to implement exactly this business model. But more change is coming. AI is once again transforming the industry. Yet the transformation of our business model and industry has not yet been seen. AI is newly implemented. Tools like mine and now Metrics, we are using AI, but the vast majority, well over 95+% of the entire industry, is not using AI in any meaningful way. So what is AI currently changing and what does that future look like? Well, we're doing a free webinar because I don't have time on this video to go over all of it. Check it out and make sure you click on the link below and register. We will go over and show what we're doing as well as other people are doing in the industry with AI. Also, what the future looks like, what AI might do, and how it could change customer behavior as well as competition. All of this technology and change, at first you may say that sounds scary, but that is your competitive advantage. In a world of real estate where your competitive advantage is I have lots of money, I can get low interest rates, I can buy land, and I can just have lower prices and compete, that is a big boy game. That is institutional. So this is private equity. I'm assuming most of you aren't there. I'm not, and we have a large portfolio, relatively speaking, around 300+ million in assets. But in a world of commercial real estate, that's not a lot. This model, we have to pioneer. We have to maximize and optimize. But for someone starting out, this is your path to compete in marketplaces that I don't go in, institutional people don't go in, and dominate. And best of all, it's do it for you. These tools exist. You don't have to know the ins and outs, you just need to know what they do. Just 10 years ago, revenue management, static pricing to dynamic pricing, these things weren't available for anyone except big REITs like Extra Space. Now, anybody can get them. This will be the next wave of wealth creation and storage. You may have missed the first one, which came after 2008 until 2023. Self-storage, like all commercial real estate, went into a slump and a downturn with high interest rates. It's coming out of the slump with lower prices to buy storage facilities and new technology and business model, just like 2008. This is the next and final wave of wealth in self-storage. After this one, it will consolidate like all the other asset classes. The consolidation is where you make your money. Why? Because as consolidation occurs, institutional players come in, that drives prices up, making you millions. You buy a storage facility, you do basic things, compete well, turn it around, and values go up. Occupancy and rent prices go up. You optimize, have a good asset, then you go buy another one. Or you sell that one as the industry's consolidating and you pocket millions. Once again, you missed the second wave of wealth creation in self-storage. Now is the third and final. Don't miss this one.